Hello, how's everybody?
Hello, Professor.
Hello, Professor. Good afternoon.
Yeah, good afternoon, Ying Yu, Ophelia. How's everybody else? Okay, so we have at this moment, at this time, we have like that's 11 people currently logged into the Collaborate. Let me just quickly check how many are in the discussion board. So in the discussion board, in today's forum, we have 14. So we're still missing 3 people. And as of now, we're missing 2 people because we have 12 here. So good. All right. So we are. You must have received an email uh, earlier today or last night that there's quiz 1, right? Everyone knows that, right? Everyone is aware of, right? Everyone. Quiz 1 is going to be available from tomorrow, and it's not visible just yet, but let's see. But the announcement has gone out. Okay, let me just share my. Okay, we have 13 people now. Okay, Abraham. Yeah, go ahead, Abraham.
Question.
Yeah.
When we're done with the quiz, will we see the grades right there?
Yeah. Sure.
Uh,
It's not the letter grade, but score. You will be able to see the score because once it is you submit it, and then you'll be able to see uh, what you got wrong first until what what is the correct answers and correct answers to the and feedback will be available after the uh, after the due date. Okay, if you have submitted it earlier than uh, the due date, you will be only able to see the submitted answers, but the feedback and the correct answers will be visible after the due date. Okay, give me a second. I gotta take a call. Put you on a all right, guys. I have an urgent call from the chair of the department. So give me. Um, I'll put you on a break for about 5-10 minutes. Anyway, instead of we normally go on without any break. So for the entire 2 hours, 2 hours and 15 minutes, we normally take no break. So let's take a break in advance. Okay, so let me put you uh, on a hold. Okay, I'll unmute mute the microphone. Okay, I'll be back. All right, I'm back. Sorry about that. That was, my department chair, and uh, we have, some curriculum revision things. So this is, um, and it's a headache, when because it has to go through, not just, departmental level, but on it has to go through a lot of red tapes and things on college level. Anyway, so we were where were we? Um, okay. So I'm not sharing the screen yet. So let me share the screen. So everybody, um, I believe, so everyone got this email about the about quiz one, right? It's going to become visible in the here, right? Currently, only this one is visible. If I exit student, oh, why is it like this? It will become visible, right? It will become visible. Everything is already built in, so um, uh, it takes a lot of since spring. We went online, in spring 2019, and since then, we had like almost 2 years, not 2 years, but 1 year and almost, yeah, uh, half of spring 2019, and fall to fall 1 year, and spring almost one and a half, more than 1.5 year. Having experience of teaching online for solely entirely online, and all of the teaching material has transported right to online. So I basically it's architecture, right? Building an online course with every material, all the materials available online. It's an architecture, and it's a meticulous um, mechanism. It's a uh, intricate mechanism. Something has to become activated at a certain point, and all these things I have done all these years, and so it's going to be there tomorrow. Um, but before that, we will need to. Okay, here lecture notes. So let me pull up. Let me pull up the. Let me pull up the thing. Our 100. Oh, it's taking so much time. So, anyways, we were talking about yesterday the balance sheet, right? And I said the balance sheet basically shows where the capital came from, right? Where the money capital came from. Remember that? The money capital came in two forms. One, uh, liabilities, right? In other words, debt, short-term, long-term debt, right? And then equity, right? In these two forms, the money capital came to the company, right, from lenders and from the shareholders or venture capital at this point. Because remember, we are assuming that you are starting up a company, you are starting up a business, right? As you start up a business, you need this $10 million as a startup capital. Why? Because you need plant and equipment. Plant and equipment alone requires 9.5 million, right? Plant and equipment, land and building, that alone requires 9.5 million, right? And there can be no manufacturing without plant and equipment. And then if it is, and this is roughly 10 million, I said, we would just, approximate it because it's almost 10 million. And so the other, 0.5 million is, so out of 10 million, 9.5 million transformed into hard assets or non-current assets. I told you, what are the other names? What are the other names for non-current assets?
Long-term and short-term.
Say that again?
Long-term and short-term.
Say that? No.
Long-term and short-term assets.
No. I'm talking about non-current assets. I only asked what are other names for non-current assets.
Long-term assets.
Long-term assets, that's one, yes. And what else?
Fixed assets, physical assets.
Yes, fixed assets, physical assets, and
real
also
assets, hard
real assets. Yeah. Huh?
I said real assets and hard assets.
Hard assets, yeah. Yeah, basically, yeah, that's it. That's everything. Non-current assets are physical assets, real assets, right? Fixed assets. So plant and equipment clearly is, physical and real in nature, right? And there can be no manufacturing, right, without physical assets, right? And another thing, it's called fixed assets as well. But company vehicle. What is it considered as? Is it fixed assets or not? Company vehicle. Company vehicle, like trucks or whatever, for trucks for I don't know, delivery, or I mean, you don't necessarily have to have trucks. Yeah, it's a physical asset, so it's a fixed asset too. I mean, just because it's moving, you might say, oh, so isn't it a mobile asset? No, there is no such thing as mobile asset. It's either physical asset, right? Non-current assets, real assets, right? Otherwise, it's all current asset. Current assets are liquid asset. Obviously, so company vehicle is a fixed asset, right? Although it is moving, fixed doesn't mean it is fixed on a place, right? It's fixed means, physical assets, right? Okay, so let me pull up also, let me pull up the Excel file. So that, okay, the Excel file is what you are seeing. And okay, so basically now we understand the structure of the balance sheet, right? The asset side and liabilities and equity side must balance out. They must match. They must balance out. Otherwise, it's not a balance sheet, because it's called balance sheet because they balance out. So it's quite obvious what physical assets are. It's not difficult to understand. Plant and equipment, building and land, right? And then the money, they came from the money for acquiring this, the money capital for acquiring this basically came from your liabilities and equity, right? Because the liabilities and equity are basically sources of capital, right? That's the source of capital, because the source is either debt or equity, source of capital. So this side, liabilities and equity side, is the source of capital, and then the asset side, that's the use of capital, how that money capital was used, and in what form they are held, right? And so depreciation, I'm going to talk about it later, but let's take a look into the current assets. Current assets are short-term assets. So current assets are unlike current liabilities. In case in current liabilities, that current means basically short-term. Current means now, present, right? Short-term. That means take a look at the current liabilities. Accounts payable. Accounts payable is literally it's a credit purchase. You bought something. And we talked about promissory note before. Did we talk about promissory note before? Yeah, we did. Because why? Remember, when did we talk about promissory note? When you talked about the bonds, right? When you talked about bonds, I said short-term corporate bond is called commercial paper. And another name for that is also another promissory note is another name for commercial paper, right? Does that make sense? And so what are promissory notes used for? Promissory notes are used as payment, right? But the name promissory note means clearly it's a promise to pay. So it's an IOU. But again, promissory notes are not something you can issue. You think you can write a promissory note? No. I mean, you can write an IOU and borrow money from your friends or family, but it's because they are your family and friends. You cannot write an IOU and go to an Apple store and write an IOU, right? You understand? You cannot pay for an iPhone with an IOU. Why? Because you don't have any credit. You are not a business. Businesses have credit ratings, and they can issue a promissory note. But for individuals, no. Okay. And so accounts payable is basically, your credit purchase, the purchase you made on credit. Okay. And that has to be paid within, within 1 year. Technically, it's any length of any maturity within 1 year, but it will normally, no more than 60 days. Usually, the time limit is, usually 60 days. Notes payable, that literally means promissory notes. Then what's the difference between accounts payable and notes payable? Accounts payable consists mainly of invoices. Accounts payable mainly consists of invoices. Why? Think about it. What does invoice mean? Can anybody tell me what does invoice mean?
That you sent out a bill?
Say that again?
That you've sent out a bill?
Okay. Yeah, depending on who you are. Are you a buyer or are you the seller? If you're the buyer, and who was that? Was it Safia?
Yes.
Okay, Safia. You said invoice means that you sent out a bill. So who is you?
If you're the seller, you're sending out a bill. If you are
It's the seller.
receiver,
But you are holding invoice. Then who are you?
so
If
you
you're
are
holding
the
invoice,
buyer.
you are the buyer. Yes. So if you are holding, if that invoice, you are holding the invoice, that means
You receive goods. You're the buyer.
huh?
that you're the buyer. You've received some. You're going to be receiving goods that you've already received. Well, you've received goods. That's why you have a notice to pay back.
Yes, yes, yes. You're the buyer. You receive the good, but you owe them payment, right? Isn't that right? That's what it means.
Yeah.
When you receive an invoice, that means you haven't paid yet, so they sent you an invoice. Okay, so that's what
So
accounts.
it's like a bill statement.
Uh, yes, they can call it in different other ways. Sometimes yeah, billing statement, or I mean, normally, in if you eat in a restaurant, right,
Yeah.
you will ask for a check, and it's also called bill. They give you a bill. That means you need to pay, right? But again, that's usually because in a restaurant you eat first, right, and pay. But you can also pay first and eat, right? I mean, McDonald's. You go to McDonald's. It's not like McDonald's. You eat first and pay later, right? But most restaurants, you eat first and pay later. Also, it's just like that. If you go to an Apple store, you buy an iPhone, you have to pay first, right? But in B2B, in business to business, generally they pay later. The
It's
buyer
like
pays
agreement.
later. Hmm?
It's like agreement payment.
It's like what?
Agreement payment.
Agreement?
Yes.
Yeah, yeah, of course. It's
Between the owner
there
and
doesn't have to look between. So
the seller.
promissory note, invoices and promissory notes are used only in B2B, business to business, right? Business to business. And when you have in B2B, you can have a binding contract for as a supplier and buyer, right? As the suppose you are Dell, like in a computer manufacturer, Dell, between computer manufacturer and the parts and components supplier. A computer, Dell doesn't make everything. Um, the parts and components that go into the computer, they outsource it. You understand? They outsource it. So there are suppliers of parts and components, and between the uh, between Dell and the supplier of parts and component, there can be a agreement or contract, supply contract, right? Like supply contract for binding contract for 2 years or for 5 years, or maybe there doesn't have to be. From Dell's perspective, Dell doesn't want to be bound by such a contract because Dell wants to shop around. If you're a buyer, you don't want to tie you up with some kind of contract, right? I mean, um, I want to shop around. If and of course, if it is something like insurance, there will have to be a binding contract. If it is like utility, there will have to be. But if it is something like convenience goods, clothing, I mean, you don't want you want to shop around when you go out, shopping for a new jacket or new pair of pants. You don't want to tie yourself up with one seller, right? You can just so from buyer's perspective, you want to be free to choose, from different suppliers, because if there are multiple suppliers, um, you can, shop competitively, right? Again, sometimes, even the buyers want to just stick with one supplier because if the quality of the parts of this supplier X is the best, and you don't want and your product needs to be performing at at its best at its best, performance, right? So then, not to secure the supply of these parts, you write a contract. But generally, it's these seller of these suppliers who are more eager to lock into a contract. Why? Because these usually suppliers are smaller companies, right? And a manufacturer like Dell is an industry giant. I mean, small suppliers, small businesses, having a secured, steady stream of order from this giant manufacturer would guarantee the revenue, right? It will guarantee the sales revenue to this small business, right? So anyway, the thing is, so if you have already a supply contract, then usually they don't they don't pay just because every time they shipped, right? Just because they ship the parts, it's not like they pay every time. They will just send the invoice, and then they will later, the buyer will pay that invoice later, right? Like at the end of every month or at the end of every quarter, right? And even if there's no binding contract in business to business, it is it is customary that when they order, and think about it, if you want a steady long-term business relationship, right? If you want a steady long-term business relationship, usually the supplier, the smaller guys, will have to do a favor to big guys, and think about it. If you are a small supplier, small manufacturer of something like a small part that goes into the computer, Dell is a valued customer, right? And the order from Dell can mean the revenue revenue to pay, the revenue to sustain. If the small company has 100 employees, there will be a huge source of income for everyone, right? It could be one order to Dell could be sustain this company for even 1 year, right? Just one shipment. So no small in this B2B situation, no small supplier, no small guys want to irritate, right? No small guys want to rub against the big buyer. So they are not in a very comfortable position to demand the payment. You understand? Do you understand?
Yes.
Yeah.
Yeah, just the seller, and especially if the seller is a small guy, the seller is not in a very good position to demand immediate payment. They will always say, yeah, you can pay 30 days later. You can pay 60 days later. This is invoice. Invoice says pay. Of course, if they pay immediately, that's good. So usually invoices, if you pay within 2 days, 5% discount or something like that, 2% discount. But usually, invoices will they will honor, if the buyer pays ASAP, good. But even if they don't pay immediately, as long as they pay within 1 month, or the supplier will have to live with that. Of course, not all these suppliers are like that. Not all the sellers are small guys. Think about Intel. What is Intel? What kind of company is Intel? You guys know?
They make chips.
Yeah, they make, memory chips. They make memory chips. And Intel is also, industry giant, huge industry giant, right? They're also huge industry giant. So Intel, um, of course, Dell would purchase, memory chips from Intel. Between Dell and Intel, the power, uh, uh, um, balance of power, will be pretty much, the same. The balance of power will be pretty much, equal on both sides. Um, uh, Dell must not irritate Intel, um, either, because if Dell irritates Intel and they don't get the chips supplied in time, they will, have huge, they will suffer huge damage to their sale, right? Uh, but usually, it's not exactly like, the power is not, uh, the balance of power is not, even. It's generally skewed more in favor of the bigger guy. Now, so promissory notes. Accounts payable, they are generally, invoices. Notes payable, that means promissory notes. And promissory notes, I told you, it's, uh, only between, in B2B, business to business. You cannot write a promissory note and, take buy an iPhone from Apple Store, because nobody honors that, right? It has to be a business, right? That has credit rating, good credit rating. Um, uh, your promissory note is only on a personal level. So maybe your, parents, your family, your friends may honor it, but, not, you cannot even buy any coffee from Starbucks with your promissory note, right? You understand? Um, so if you think, then the promissory note is also pretty much the same thing. Um, uh, if it's the buyer who issues the promissory note, because buyer bought something, and instead of, paying uh, with cash, um, or credit card, or with a check, they issue promissory notes. So it's like, and usually the maturity of the promissory notes are usually 30 days or 60 days. Okay, theoretically it can be up to 270 days, but that's only theoretically possible. In reality, nobody will be happy to receive like 270-day promissory note, right? Nobody will be happy to. And so the promissory note is basically like, it looks like a check, but, the difference is that the promissory note has, interest rate. It carries interest rate, and it has maturity. It says, due, 30 days, or, due 60 days. Or so if you think about it, promissory note is a credit sale imposed by the buyer, right? Isn't that right? Think about it. Because otherwise they will have to pay cash right away. But if they paid with 60-day promissory note, what does that mean? The buyer is deferring payment for 60 days, right? Buyer is deferring. So it is like a credit sale, whether the seller likes it or not. It is the credit sale imposed by the buyer, right? But then again, as a seller, you cannot say no to that, because you don't want to irritate, right? You don't want to rub against, uh, the buyer, because especially if you're a small supplier, small seller, and a big giant, buyer, industry giant, uh, you cannot say no. You don't want to lose their business, right? Okay, so they are like accounts payable, notes payable. They are like short-term uh, lending, short-term lending to the buyer, right? Think about it. This company has accounts payable and notes payable. What does that mean? Oh, they have something to pay, right? They bought something and they didn't pay, but they are required to pay within 30 days or 60 days. So um, this is like getting a short-term loan, isn't it right? The buyer is getting a short-term loan, right? Because they don't, if they bought something, supplies from, uh, they bought parts and components from a small supplier in the amount of $1 million for $1 million for $1 million worth. You bought parts and you paid with promissory note. So that's like then you are deferring payment for 60 days. So it's like getting a short-term loan, 60-day loan for $1 million from the buyer, right? If I'm deferring payment for the next 60 days, then it's like getting a loan for 60 days, right? Does that make sense, everyone? Hmm?
Yes, I understand.
Okay, thank you. Who was that? Who said? Who said? Who said that?
Ophelia.
Who said? I understand. Ophelia. Okay, thank you, Ophelia, because I, I, you deserve, a 0.5 just for that, because I told you I hate silence for more than 5 seconds, because it's like I'm just shouting into a hollow chamber. I mean, at least if it's a echo chamber, echo chamber, it will be my voice back, but at least uh, Ophelia, you confirmed to me that I'm not speaking to hollow vacuum, right? So just for that, you deserve already 0.25. All righty. And then interest payment. Of course, what are interest payments? It's because we have bonds and mortgage. We got, that means we sold bond in the bond market. Bonds are basically long-term debt, so there will be interest, that coupon interest that we have to pay every 6 months. And you got a loan from the bank, and I wrote mortgage in there. I mean, why didn't I write loan? Why did I write mortgage instead? Well, because think about it. It is all real. Think about it. Land and building, plant and equipment, 6 million. I mean, a lot. That alone, plant and equipment alone is 6 million, right? And then the lendings are the borrowing, the debt is only 5.75 million. That alone cannot finance plant and equipment. Of course, because we have equity of 4 million, uh, uh, at least 4 million of this plant and equipment was covered, right? 4 million out of 6 million was covered by the capital that was paid in by equity, right? And then remaining 2 million was probably from bonds. But then land and building 3.5 million. This is exactly 3.5 million. Land and building. Land and building is what? It's real estate. Real estate. So probably you got this loan to acquire building and land. Makes sense? So that's why it is So that's a mortgage loan because, and what is a mortgage loan? It's basically, look, think about it. It's not only this land and building, but when you buy a car or when you buy a house, how many of you? I don't think any of you own a house, right? You rent, right? If you own a house, you must have got a mortgage loan, right? But I don't think any one of you have that experience just yet. But what about car? Does anyone have a car?
Yes, I have.
Okay, and when you bought a car, did you finance? Or did you pay? Obviously, I don't think you paid, full price lump sum, right? In lump sum. Did you finance?
Uh, Actually, I bought two cars. One of that
Yeah.
I paid off, and one of that I didn't finance.
Okay. When you said you paid off, that means originally it was financed, right?
No, I
No,
paid.
you paid full.
Yes,
Okay.
I paid
Yeah.
$22,000, and I got the car.
Oh,
That's it.
up front. Okay. Okay. And the other one is financed, right?
Yes,
Now,
yes,
okay, good. The one that is financed, basically that means what? You make a down payment,
It's owned by the
and
bank
the
until you
rest,
pay it off.
yeah, the rest is paid by the bank, right? Then,
yes,
so the dealership gets the money, right? So they release the car, and then from then on, you make monthly payment to the bank, right?
yes, yes.
So but then the the title the title to the title of the title to the
Of the
title of
car,
the
it will be in the
car,
bank.
yeah, is with the bank.
Yes,
Why? Because
Because
the
you don't own
title
it
is
yet
with the
until you pay
bank
it off.
until you pay it off, right? Makes sense.
yes, yes.
So
They will keep
then
the
what
title.
they yeah, when you pay it off, you get the title, right? When you pay it
Yes,
off, but then until then, the car is so in that sense, the car is what? The car is basically the reason the bank loaned you uh, the difference between the price of the car and the down payment, right? The bank loaned you that. I don't know if you have a good credit score or bad credit score, but regardless, I mean, if you have a good credit score, your interest must have been very low. If you didn't have if you had a bad credit score, interest rate had to be high because the bank is taking a high risk. But
yes,
the idea is, yeah, regardless of the credit score, I mean, if you have a bad credit score, they will charge high interest. But you may have heard, every time, at night, when you are watching TV, then there's TV commercial, usually car dealership. They say, uh, bad credit, no problem. They say that, right? Of course, the dealership will always say that because they want to move the cars out. They must,
Well,
right, sell the cars. But how can, but from the bank's perspective, right? How can they, how can they, lend you the money if you have very bad credit? Of course, they charge high interest, but charging high interest to a loan, is it good enough? Is it enough? Charging high. What if you default? Uh, what if you default? I mean, you've been making payments, but at one point, you default. If you default, continuously 3, 4, 5 times, what's going to happen? Hmm? If you default several times, what's going to happen?
they'll still
What's
take your
going to
car.
happen? They will let you keep the car, huh?
They'll take it
What
back.
was that,
They'll
Professor?
take your car
My
back.
internet connection is bad.
They'll take your car back. They'll repossess your car.
Yeah, they repossess your car. They repossess your car. Why? Because the title is with them. The title is with them, not with you, right? They can always repossess the car. And in that sense, the car is I mean, I want you to nail this word, but if but
Bank
to nail
bank
the word,
gonna sell the car to get the money back.
yeah. So what is that called? So in that context, the car is called what?
The representative.
I guess a liability because you don't own it yet. You haven't paid it off. But then again, it could. No,
No.
technically an
They're
asset
gonna
because
Yeah,
tow the
you're
car.
You
They're gonna
you
tow
have
the
a
car.
liability on the car. You have a liability on the car, and the
so
liability
you're
is
thinking.
the remaining balance of the loan. Okay, remaining balance of the. But what I want, as I said, I want you to nail the word. But the word. I mean, if you understand the context, you can nail the word. But usually people don't get it unless there is some expression, idiomatic expression that goes with the word. If they can repossess it, what does that mean? If they can repossess the car, then that means the car is.
Owned by them,
Their
not yours.
car belongs to them.
Yeah. That's right. But there's a word. Uh, I have to say this. If I
A
say
loan.
the car is, huh?
It's kind of like a
What
loan.
did you
Like
say?
it's not yours until you pay it
No,
off.
no, 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 no. The car is not a loan. The there is a loan against the car, of course, but the car is not. Uh, there's you made a down payment. There's certainly your equity in there. Um, I usually, this is why, people, you need a big, picture. You need to be able to think holistically. You should be able to see the big picture and think holistically. But when I give this idiomatic expression, then you know what that word is. But then without that idiomatic expression, then you are clueless. So in this case, the car. Okay, I will give you that expression. The expression is idiomatic expression is the car is put up as. The car is put up as.
Collateral.
Payment.
Collateral.
Oh
Payment.
Yeah.
yes. Who said collateral? Who said?
I
Who
said it.
said
Someone said it
collateral?
before me.
Huh? Who said collateral? Come on.
I don't know. I thought we both said. I don't know.
Yeah, we
No,
did, but I
no.
kind of felt like
So
you said it a tad bit before me.
so who was that? Who was that? You
A
don't
bull.
want the extra credit? Huh?
Bull.
Who
What
said
was
that?
that? What was that?
Huh?
A
A
bull.
bull.
Abul. Okay, Abul. All right, Abul. You got 0.25 for yes, it's collateral. So you see what? When so people are basically slaves to habits. Everything is habit. People are enslaved to habit. Idiomatic expression is habit. It's habitual. I mean, if you put it in if you paraphrase it, you don't get it. The whole context was they can repossess the car. So why? Because the title is with them. So in this context, the car is and I've been telling you, you can nail it if you understand this context. But putting it into this big picture, in this holistic picture, and which is paraphrased, um, uh, and the answer you already know, but you just can't nail it without that idiomatic expression. When I said, so there's something that you could have known, you could have nailed, you couldn't, and only when you are triggered, when that is triggered by the expression put up as, the car is put up as, then the collateral comes up. So think about it. Only the word collateral is triggered only by that expression. Car is put up as. But you should detach yourself from that habit, right? That expression is idiomatic expression is habit. People, because they say it like that. But if you detach yourself, I mean, if you're detached from that habit, you don't know the word. You can't nail the word. So That's the problem. You should be able to nail that word without nail that answer without that trigger or that that habitual expression that is associated with that, right? So think about it. Yeah, the reason, just like the car, when you buy a house with a mortgage loan, the title is not with you, it's with the bank, right? Until you pay it off. So the house is put up as collateral. And this makes it possible. This makes the financing possible, right? Understand? That's why they say bad credit, no credit. In the commercial, the car dealerships say bad credit, no problem. Why? The banks are willing to lend. I mean, if you have a bad credit, fine, they will charge you a high interest, right? But not only because of that, they can always repossess the car. The minute you buy the car by financing, the title is not with you, the title is with them. The car is already a collateral. So in finance terms, in finance speak, or in financial accounting speak, they say the asset is collateralized. The asset is collateralized. Okay? The car is collateralized, plant and equipment is collateralized, building and land is collateralized. I mean, if you paid at least, because you have $4 million in equity, you could have, paid, for building and land, just, in cash. But, nobody does that. That would be, and the building and land, most likely, that's bought with mortgage. Okay, it means the building and plant and equipment, most likely, used, at least, 4 million was equity, but at least 2 million was debt. So, and then if that was by bond, it's not collateralized. If that was by bond, it's not collateral. 6 million out of 6 million, if 4 million was paid with equity and 2 million was paid by the capital raised from bond, it's not collateralized, because bond is not collateralized. Bond is like, it's a debenture, meaning it's a debt that is not secured by any collateral. Okay, so bond is a loan that is 100% debenture, meaning based on your credit rating. Okay, company's credit rating. Okay, whereas loan, they will want collateral. Think about it. If you're starting up, even if you're starting up a small business like a coffee shop, and you want to get a loan from a bank, you cannot. I told you, it's going to be very difficult. But they will do that if you put up a collateral, right? So usually, something like real estate, car, aircraft, right? They are self-collateralizing, right? Train, railroad cars, they are self-collateralizing because it can be, repossessed and sold anytime, right? If you default, they will always repossess and liquidate to recover there, right? So they are self-collateralizing, right? But coffee shop, if you're trying to get a loan for a coffee shop, there isn't that much that can be collateralized, right? Because the space is, on a lease, you're paying a rent, you rented the space, and your most expensive, most valuable equipment is probably the coffee maker, and probably a refrigerator and the coffee maker, or some oven. How much collateral value do they have? Very, very minimal. They don't. So that's why it's going to be very difficult to. But anyway, so this explains, the connection between the asset side and the liability side, and then we understand, accounts payable, notes payable, interest payment. Now, accruals mean, unfinished or incomplete transactions. Okay, so wages and taxes, they are incomplete transactions. Why? Think of it this way. If you work, you will get a paycheck either bi-weekly or monthly, and most of the times bi-weekly. And if you get a bi-weekly paycheck, when do you get it? I mean, if you get a monthly check, you will get it at like 25th of the month, or the last day of the month, or whatever, 30th of the month, or 25th of the month. But if you get a bi-weekly paycheck, you get it on Friday, right? Suppose, but then, financial statements are updated. Financial statements are updated. How often? Does anyone know how often the financial statements are updated?
Which kind of
Updated
financial
means,
statement?
Say that again.
Which type of financial statement?
Oh, income statement, balance sheet. We're talking about income statement and balance sheet.
Typically, income
Okay,
statements are monthly, right?
Who said quarterly?
Sophia.
Yes, Safia. Okay, Safia, you got 0.25 for that. Yes, it's updated quarterly. Of course, yeah, it can be updated monthly too. But what I'm saying is, updating means, you are settling all the accounts. I mean, you are bring a closure to the statement. So in other words, the numbers will all have to be settled. All these accounts, all these line items must be settled. In other words, they must be, so the differences must be reconciled and everything. Yeah, they can do it monthly. I mean, they can do it even weekly, but that is just, if they do it monthly or weekly, it's just, out of their own need. But the law requires, or, the GAAP. You understand GAAP, generally accepted accounting principle, right? Generally accepted accounting principle requires that to be at least quarterly. And the reason it is also quarterly is because companies, all the businesses, release their earnings report quarterly, right? Every quarter. So which quarter are we in? Are we in what? Second quarter or third quarter?
Third quarter.
Third quarter. We're in the third quarter, yes. Because second quarter just ended. June 30th, that's the end of the second quarter. July, I'm sorry. March is the end of the March 30th, end of the first quarter. April, May, June, end of the second quarter, right? End of the second quarter. From July, we are in the third quarter. We're in the third quarter. And recently, if any of you are investing in stocks, or watching the stock market closely, recently you may have seen that quite recently the earnings reports are coming in recently. All these, Google, Apple, Exxon, Amazon, earnings report are coming in. Now, why now? I mean, we are in the first week. This is the first week of August, and they call it earnings season. Why? Because think about it. And the earnings report that's coming in is the earnings of which quarter?
Probably the first.
No. It's the
So if this is the
earnings
fourth
report
quarter,
of
then
the
is there
second
anything the
quarter.
third one? No.
No, it cannot be third. We are barely in the third quarter. I mean, we are in the middle of the third quarter. If you're in the middle of the third quarter, we cannot close the book. You understand? You cannot. You don't have the final data of the third quarter. You understand? Third quarter earnings can only be calculated after the third quarter is over. So all these earnings reports that are coming in is the earnings report of the second quarter. Make sense? After second quarter is over, after second quarter has ended, now they compile the data. They compile the data and then they calculate, basically, they calculate, how much the equity has changed, how much their, debt has changed, how much, their share price has changed, market capitalization has changed, etc., etc. They do that, and then, mainly it's, balance sheet and income statement that they are, updating. After the end of the second quarter, they will update their, balance sheet and income statement, and then they can. Now, you remember yesterday we talked about how we get the earnings per share. Think about it. Second, they do this, for the second quarter, right? And then they can calculate earnings per share, right? So this comes in. So think about it. Usually, so it means it takes about a month for them to compile the data, and then do these computations, and then release it in the first week of the second month of the following quarter, right? Does that make sense? So actually, then in May, first week of May, that was the earnings season, and that was the earnings report of the first quarter. Understand? And so then July, August, September, that's the third quarter. Once third quarter is over, then around the first week of October, then another earnings report, and then that earnings report will be of the third quarter. And the fourth quarter earnings report will be in around in the February of the next year, right? Does that make sense? So because of that, that's the cycle. Basically, they update the book, they update the balance sheet and income statement at least quarterly, right? Make sense? But for internal purpose, they can update it, even weekly or even, monthly. But, officially, it is quarterly, right? So the reason I said that was, how often they are updated, quarterly, right? So the thing is, now think about it. Because I was talking about accruals, and I told you, accruals are basically, incomplete transactions. Why is it incomplete? Because it is still accruing. So, okay, what would be the reason? So I said bi-weekly, right? If you're getting a paycheck, it would most likely be bi-weekly, and Friday, you get it on Friday. You get paid on Friday. But the end of the month, so you internally, you update it monthly. So at the end of the month, let's say, at the end of the month, you need to close the book. In other words, you need to update the numbers there. You need to close the book. And then the end of the month is not Friday. End of the month doesn't have to be Friday. It can be any day. right? It can be any day. It could be Wednesday, it could be Monday, end of the month, and then you have to close the book. And the thing is, so you have to then, report. You have to write down here. You have to enter the wages accrued up to Wednesday, right? The wages accrued up to Wednesday. But then, was the wages actually paid? No, it's not paid yet, because Wednesday is not the pay day. It's not paid. The transaction has not happened. Think about it. Everything here, all the numbers here are basically telling you these are transactions that have been completed as of, that date. So if the wages accrued until the Wednesday was 5 million, everything is in thousands, so this is 5 million, not 5,000. So wages accrued until Wednesday was 5 million. Okay, 5,000 or 5 million, doesn't matter. But wages were not paid. In other words, the transaction wasn't completed. Still, you enter it there as if it is a completed transaction, but it's not completed. That's why it is called accrual. It is just something that has accrued up to that point, and it wasn't paid out, but you have to record it there. You have to put it in there, right? Just because the transaction hasn't been completed, you cannot leave it blank. You understand? So that's why it is called accruals. In other words, it's nothing very complicated. It's just as of the last day of the month, which is Wednesday, the accrued wages are 5,000. That's what it means. And the transaction has not been completed. The transaction, meaning these wages are not the wages paid out. You understand? If the wages are paid out, it's transaction completed. It's a completed transaction. But if it is not, if it hasn't been paid out yet, it's just an accrual, not finished, completed transaction. Okay, does that make sense?
Yes.
Okay, who said yes? Because always only one person. Huh? Who was that?
Sophia.
Yes.
Sophia.
All right, thank you. Two people for
It's
from.
it's an earning wage that is not paid yet to the employee, right?
Yeah, it's the wages that have not been paid out to the employees just yet. So transaction has not been completed, right?
Yes.
And basically you enter the numbers here are supposed to be the ones that have been completed, but this is not yet completed. But
Yeah, we
just
have to,
because of that, you cannot leave this blank,
we
right?
have to record it on the book
Yeah,
in
it's
order
just
to pay at
recorded.
the end of the month.
It's the wages accrued up to that point. It's not been completed, right? It's not been paid out because it's not been paid out because it's not Friday. It's not been paid out yet. But whatever has accrued up to that point, you have to enter it there, and that's why it's called accruals. Okay. Now, current asset side. Now, so we understand cash. Cash is current asset. Look, first of all, if you look at the current asset side, current assets, this section, these are all liquid assets. Liquid meaning they can be easily turned into cash, and they are listed in the order of liquidity. So think about it. Cash is already cash, so cash is the most liquid. Cash is the most liquid asset. Okay. Cash equivalents are usually, cash equivalents are very short-term bonds, short-term securities like short-term promissory notes, short-term notes, fairly short-term, like 1 day, 2 days, that are considered as liquid as cash. Okay. Obviously, checks are cash equivalents, right? Checks are cash equivalents. In the old days, they used traveler's checks. I don't know if anybody even heard of traveler's check, but even in the 80s and 90s, traveler's checks were used. Traveler's checks were like, and of course, these days, if you travel overseas, travel to overseas,
The concept is like a
credit
money
card
order.
is. Yeah. Traveler's check is like money order, accepted everywhere in the world because usually it's backed by, issued by American Express or internationally uh, uh, known banks, right? Renowned banks. So it's accepted everywhere. These days you just carry credit card. That's it. Everywhere you can. But even until 1980s, there were in early 1990s, there were countries, that credit cards were not really well accepted. Of course, in the first world, in the developed economies, yeah, you can, but if you go to non-developed or developing worlds, the financial system was not well developed, so credit cards were not, sometimes, it was hard, to use. And even in the U.S., have you guys ever used Discover card? Discover? You heard of Discover card, right? Yeah, but not too many people use. Not too many people use Discover card, and not too many partners, right? Not too many stores accept Discover card. I used to have a Discover card long time ago, but obviously it fell out of circulation because I had it, but I couldn't use it because you try to use it, but they say, oh, we don't accept Discover card. So then, automatically, naturally, it will fall out of circulation. So think about it. There were times when credit cards were like that. So you had to use, a traveler's check. It's, cash equivalent. Also, there's a link, if you go to, I don't know, your topic. We are already, actually, this is not where we are. You must understand. Oh, this is where we are now. Topic 3. This is where the lecture is, right? A collaborate session is only a reflection and review of the past lectures. So we are like, collaborate session is like 1 week behind. It's like 1 week behind. So if you think about it, this was over as of July 28th, and still there's a link. You can look it up. The cash, definition of cash equivalents. Okay, so where are we? So here, and marketable securities. That marketable securities are like stocks, bonds, promissory notes. I already explained. Buyers, buyers prefer to pay with promissory notes. Why? Think about it. In B2B, there are 4 methods of payment, or payment modes or modalities. Payment modalities. Well, of course, you can pay with cash. You can pay with check, right? Company check, right? Business. You can pay with credit card, of course, corporate card, right? And then you can pay with promissory note. But then think about it. I said this is the most preferred payment method by whom? By the buyer or by the seller? The promissory note is the most preferred payment method by whom? By the seller or by the buyer? Anyone?
The buyer.
Buyer, yes. Who said that?
Sophia.
Safia. Oh, okay, Safia. You always, like you give, um, Safia. I'm gonna post the update. Um, once the quiz one results are in, I will post the update of the uh, attendance and test results. And you will see, Safia, you have already racked up 10 points, for attendance and participation. I mean, that was supposed to be, um, of course, there's no limit in, because if you don't do well, if you, let's say you mess up, exams, at least, this will compensate, what you earn in, participation point. It will compensate it. Yeah, it's the most preferred method by the buyer. Why? It buys you more time. Because if you, so the buyer bought $1 million worth of parts from the supplier. This, if they paid cash, what does that mean? They don't have this cash anymore. They don't, in other words, they can't use this cash. They can't use this $1 million anymore, right? So you might wonder, why do they need to use it? I mean, isn't it used already for paying for the this parts for $1 million? Yes, but it was, if they defer payment for, let's say, 2 months, 60 days, right? Suppose, and they can invest this. They identified a very good stock that is skyrocketing now. So if you put $1 million in the stock, even for 2 months, you can probably get 20% return, right? Then wouldn't you rather do that? I mean, if you could defer payment for 2 months and you put $1 million in that and earn 20%, wouldn't you rather do that? Huh? Yeah, you would rather do that because that's why you use promissory note. And of course, then that means promissory note is the least preferred payment method by the seller. Does that make sense? The seller's standpoint and the buyer's standpoint are opposite. If it is most preferred by the buyers, then it is least preferred by the seller. Because if seller received this
They're not
1
getting their
million,
money right away.
what?
I said because the idea is that they're not getting their money right away.
Yeah, the seller could do the same thing. In other words, they could put this 1 million into that stock, and they could have earned 20% over just 2 months, right? So they are basically foregoing that opportunity. Seller is foregoing that opportunity. That's why the promissory note carries some interest. Think about it. Sellers are reluctant to receive promissory notes, but they accept it only because they don't want to irritate the buyer, right? Of course, the seller, as I said, if the balance of power is pretty much even between the seller and buyer, seller can say no, right? But they wouldn't do that either because anyway, the big buyer is still a big buyer. They will buy. I mean, Intel is the seller of the memory chips. Dell is the buyer of memory chips. Dell is a big company. Dell means a big business, big sale to Intel as well. So even though Intel is also as powerful in the market, and Intel is also an industry giant, they wouldn't want to forego. They wouldn't want to miss out on that opportunity to sell $1 million worth of chips to microchips to Dell, because then that is if Intel misses out if Intel misses out on that opportunity to sell 1 million, then that opportunity goes to Intel's competitor, right? And if it is good for your competitor, it's obviously bad for you. It better be the other way around. Isn't it right? Isn't it right? If
Yes.
one of us has to die in a battle, in a combat, in a war between the enemy and me, if one of us has to die, it better be that guy, the enemy, not me. You understand?
Of course.
Yeah.
Not because I enjoy to kill someone, but because it's better that it's better that the enemy is the one that is dead than me, right?
Yeah.
1
Yes.
million, 1 million more sales revenue for my competitor is 1 million less sales revenue for me, right? So even if Intel is a big guy, right? Even if Intel is a powerful industry giant, Intel wouldn't upset, right? Dell. So think about it. In that order, I mean, from buyer's perspective, cash is the least preferred, right? And the company check takes generally about 3 days to clear, or at most 1 week to clear. But normally it won't even take one week. It will be about 3 days. And then credit card, it will buy you 1 month. Isn't it right? When you pay with credit card, it buys you 1 month. So credit card is but if you pay with promissory note, usually, normally 2 months, 60 days. It could be 90 days, it could be 120 days, but generally they don't accept anything above 60 days. I mean, who will be, because I will be suffering for 3 months. If I'm the seller, I will be suffering for 3 months, right? Not receiving the payment. Of course, in reality, you can cash in on the promissory note. That's what's called factoring. I'm not gonna. We don't have time for that, but later if we have time, we're gonna. So, and then from the seller's perspective, cash is always the most preferred, and then check, credit card, or there's hardly any difference. Credit card, check, and of course from the seller's perspective, promissory note is the least. The promissory note that I have here, think about it. This promissory note is not my promissory note. You understand? This promissory note is not my promissory note. My promissory note is this. My promissory note is on the liability side. Why? Because if I use the promissory note, that's my liability. I will have to pay. But this promissory note is on the asset side. What does that mean? This is not my promissory note, but this is the promissory note I received from my customer. Does that make sense?
Yes.
Yeah.
Yes.
So if I'm Dell, and I sold, Dell sold, 1,000 computers to, let's say, BMCC. BMCC is, upgrading their, let's say, they're upgrading their computer labs. So they are, replacing their old computers with, So if that is the case, this is the promissory note from BMCC. That makes sense? So it is my asset because that's my claim to payment. Accounts receivable, yeah, these are basically what? My invoices, my invoices are this. I mean, my invoices are this, accounts receivable, because my invoices, Dell sent invoice to BMCC. So instead of receiving promissory note, they just shipped 1,000 computers to BMCC, and then they'll send invoice to BMCC. So this is something we are entitled to collect, right? And my suppliers' invoices are here, and that's my liabilities, and that's what I have. And they become due. They have all short-term maturity because they become due within 1 year. I mean, that means some of them becomes due in 1 week. Some of them become due in 1 month. Some of them become due in 60 days. Some of them become due in 2 weeks. I mean, they all, become due, right? The due dates are all different, but, the maximum maturity is 1 year. Now, this is the only non-liquid asset in the current asset. Non-liquid. Inventory. Now, what is inventory? Inventory is basically, there are 3 types of inventory. 3 types of inventory. And I already listed raw material, goods in process, and finished goods. Why? Think about it. If you're a manufacturer, first, inventory means, for manufacturer, inventory means inventory of raw material and inventory of finished goods. Now, from the raw material goes through the production process, right? And after the production process, they come out as what? After the production
Goods.
process, they come out as what? Huh?
Goods.
Just goods. It's finished goods. Finished, right? Out of the so raw material is the input. Input goes into the production process and comes out the output. Output is the finished goods, right? Finished product is the output, right? And then this and while they are in the middle of the production process, while it is in the middle of the production process, it is called what? While it is in the production process.
Because they are still current assets that we haven't sold yet.
Yeah, that's true. But while it is still in the production process, what is it called?
Unfinished
While
goods.
it is still
Unfinished goods.
Yeah, well, in essence, that's the same thing, but it's not called unfinished goods. It's called goods in process.
Yeah, goods in process.
Okay, goods in process or work in progress. But think about it. Why, raw material can be, there can be dollar price. You can put the dollar value on raw material because you paid money, you paid price for the raw material. Of course, that's the cost to you, isn't that right? It's the cost. You paid price for the raw material, so you can put dollar value on the raw material. And on the finished goods, you can also put dollar value because finished goods will be sold to the retailer or wholesaler, right? To the retailer or wholesaler at, our price, our factory price. It's called, you understand? It's our X factory price. It's called X factory price that leaves the factory. X price, X factory price. Okay. I mean, we can do the direct marketing. If we do the direct marketing, we can charge, retail price on it, right? But if we go through a wholesaler and retailer, or even, let's, shorten the supply chain, so we get directly to the, we supply directly to the retailer. Retailer will, mark it up because they need their margin, right? They will mark it up. But, the price that leaves the factory is called, X factory price. So we can put, now think about it. We need to put dollar values on all of that, even though the goods in process. And goods in process is hard to put dollar value. Why? It's no longer raw material, but it's not finished good yet. So what kind of dollar price can we put on it? Well, we can at least, because it's kind of, half processed or half assembled, right? When it is half assembled or, half processed, what kind of value, dollar value can we put on it? At least it would have to be greater than the value of the raw material, right? At least it should be greater than the value of the raw material because the value has been added. In other words, labor has been added to it, right? To even even if it is half assembled, the labor has been applied to it, and the capital has been used. In other words, the equipment, production equipment, has been used. So it will have to be something, greater than raw material value, but less than uh, finished goods value. But you have to track down all of them anyway. You have to track down all of them because if you don't track down the inventory, then this much value is missing. This much is unaccounted for, right? In other words, this much is unaccounted for. In other words, out of 10 million that was raised through debt and equity, this much is missing, right? And that's very precious capital. We raised that capital through debt. We raised it through equity, especially to the owners, shareholders. You have to really account for where that equity went to. And if something just disappeared, something vanished, if you cannot account for that, something vanished, right? What would they? And you are the accounting manager, or some basically someone in charge. You are the officer in charge, right? For keeping track of that. And what's going to happen? You will be held accountable. You will be held accountable, and they will, even though it was just an error or mistake, the values, a number is missing. So they will even put an embezzlement charge on you. This amount is missing. What happened? You must have embezzled it, right? How else can it be explained? So that's very important. Although it is, you have to keep track of everything. And then think about it. If you are, and where do you store, or where do you keep the inventory? Where do you store it?
In a factory?
Yeah, but anywhere in the factory. I mean, there's got to be a space.
Warehouse.
Right? Yes, warehouse. I mean, if it isn't that, if it is not huge quantity, then who said warehouse?
Gabriel.
Gabriel. Okay, Gabriel, you'll get 0.25 for that. Of course, this is a common sense answer, but nobody dares to even, other than Gabriel, nobody is trying to come up with, warehouse. I mean, if it is small quantity, maybe if there is a space in the factory, basically there's you got to put it into store it in a warehouse. But then, is warehousing free? Is warehousing free?
No.
No. Warehousing is not for free. It's not costless. Why? Sometimes you may ask, don't we own a warehouse? I mean, if we are a manufacturer, don't we own our own warehouse? I mean, on our real estate. I mean, if you have a plant, it must be standing on a land, and on that piece of land, don't we have warehouse? Even if that's the case, I mean, that can be possible. But also, we may not have a warehouse. Then, if we don't, then what do we have to do? We have to rent, right? Renting a warehouse costs us money. And it's not only renting the warehouse. we have to insure it. There is insurance. So everything costs money. So, and then if we have our own warehouse, it costs us money. Why? It's our own. So think about it. If we have very small inventory, if we keep very lean inventory, what does that mean? Small quantity. We don't even need a warehouse. We can rent it out. And that warehouse will generate income, right? So by occupying our own warehouse, we are foregoing the opportunity to rent it out. We are foregoing the opportunity to generate income using that warehouse, from that warehouse. So that is called opportunity cost. It is a cost to us. So that's why generally manufacturers don't want to keep high level of inventory, because high level of inventory costs us money. That's why they want to do JIT. Has anybody heard of JIT, inventory? What does that mean? It's simple. It's just in time. So in other words, you get the raw material delivered just in time for production. You don't pile up the raw material occupying the warehouse space that could have been otherwise rented out. Does that make sense? Just in time. And then finished goods. Look, we don't want to pile up finished goods in the factory or in our warehouse. Why? If it is being piled up, what does that mean? They're not selling. Once we have finished goods, they must be shipped immediately to the retailers or to the buyers. You understand? That way, we can keep only very lean inventory, which won't cost us any even opportunity cost. And think about it. As long as we have inventory, we have to, it's not only warehousing cost, but also we have to pay insurance, right? Makes sense? It's best not to incur those costs. So that's why just-in-time inventory, right? Everyone understands that? Okay?
Yeah.
Yes, Professor.
Okay, so basically, we broke down, we analyzed everything, and then that means, okay, so how does this, okay, so this equity, okay, equity was supplied by the venture capital, I told you, so that was, the original shareholder, or the original partners or original shareholders, right? A venture capital, right? So if this is the equity, right? Now think about it. What is the return on investment for this company? How do you know? How would you calculate the return on investment for the company?
By calculating their profit. So taking what they've earned minus the expenses.
What?
Taking what they've earned minus their expenses.
Yeah, income minus expenses, of course, but then that's only profit. You understand? We did that yesterday. Income minus expenses, then that's operating income or operating profit, right? Operating income or operating profit, or EBIT. That's not your net profit yet. Okay? Profit means something that belongs to the owners. Profit belongs to the owners, right?
Yes.
But does
Yes.
EBIT belong to the owner? Does the EBIT belong entirely to owners?
No.
Huh?
They still have to pay out
No.
the tax.
Why? Because interest belongs to the lenders, tax belongs to the government. So that it is not entirely owners yet. So return on investment means, return to the owners. Return on investment to the owners. You understand? So basically, net income or net profit or EAT is the profit, right? Net profit. But that's not return on investment. I mean, why? Because return on investment is a percentage. You understand? Return on investment is a percentage. You understand? Because return on investment is basically what? Remember, holding period return. Return is basically capital gains plus income, incidental income, right? And divided by initial investment. So then this is what? What is this? Well, this is the capital gains, actually, if you think about it. This is the capital gains. Why? Of course, it could be capital gains plus income because it could include dividends. But in our example, there was no dividend. There is investment income. Oh, this may be dividend. I don't know. This could be, some of this could be dividend, or some of this could be interest, right? But if some of this is, there's no breakdown of that, but some of that, if that is, anyway, that's the income. That's the remember, so that's the incidental income because it's like it's dividend, or whether it is dividend and interest, or just interest, or just dividends. This result is basically in this case it came out as negative because of the numbers there. But if this is a positive number, clearly that's profit, and then that's capital gains, basically capital gains plus incidental income, right? Now then, think about it. I told you return on investment is a rate. It's a rate of return. So it's a percentage. So then we divide it by what? We divide it by what? What do we divide it by? What do we have to divide it by? Anybody? So who is the investor here? Who is the investor here? I mean, who is the owner? Because it's return on investment, because it's the return on investment, we must know who invested. Who is the investor?
Are we not the investors?
The venture capitals?
Who? Who said? Someone said venture capital, right?
Yeah,
Yeah. Who was that? Who said venture capital?
Sophia.
Again?
Yeah, I'm
Sophia.
sorry. Let me stop answering. I'll mute myself.
No. I'm not. I'm not disappointed. I'm not saying because I'm just saying that because you are stealing the show, huh? Yeah, venture capital is the investor, right? We is too vague, right? Who is we? Of course, in this example, we assumed venture capital provided all this 4 million, but but then there is nobody else. Of course, there is someone who had this technology and who had this idea. You just got invested. You got the investment from the venture capital. I mean, you could have put also maybe 1 million came from you, right? You sold your house, you sold your car. If you are Steve Jobs and Steve Wozniak, right? These two guys, they had no money, but let's say they had house, they had cars, they both sold their houses and their cars, and came up with whatever they did, came up with 1 million, and venture capital put in 4 million. Yeah, then the original shareholders, initial original shareholders are these two original, right? Entrepreneurs, original entrepreneurs, Steve Jobs and Steve Wozniak, the original entrepreneurs, and then the venture capital. But just to make it simple, yeah, the venture capital is the owner. So think about it. So the initial investment of the venture capital, the owners, is 1 million. I mean 4 million, right? So then the profit is something. So think about it. Return on, there are two types of return on investment here. One is return on equity. Return on equity. Think about it. Equity is the owner's capital, right? And so investment came from the equity holders or the shareholders, right? You might wonder, what about the bond holders and lenders? Bondholders and lenders they are also called investors loosely, but to be specific, to be exact, they are not the owners, they are not shareholders, and since they are not owners, and their risk is limited. Owners take the full risk, isn't it right? If this business flops, if this business doesn't take off and it flops, then they will lose everything. Make sense? But lenders and bondholders, their loss is limited to, they will get their, first of all, if this company completely goes, completely crashes and goes bankrupt, then they may not even recover their principal, right? But then at least the bank has collateral. The bank has collateral. Building and land, they can repossess this and liquidate it, right? Bondholders, if this company defaults, right? Until default, they collected interest, and then if there is some physical assets left, there's plant and equipment. There's plant and equipment, and the bondholders can sue them. Look, the bank, as long as land and building can still sell at 3.5 million, they will simply repossess because the title is with them. You understand? The title is with them. They can repossess and sell. They recoup their principal. Bond holders, they will sue this company. They will sue this company, right? They will take them to the bankruptcy court and get the bankruptcy judgment. And with the bankruptcy judgment, they can seize plant and equipment. You understand? They can seize plant and equipment. And if the plant and equipment is still worth $6 million, they will they will get their principal, and maybe they can get even more. Because anyway, once they seize these assets, the owners have no right on it. The owners have no claim to it, no right. If this plant and equipment is no longer valued at 6 million, at least if it is valued for 2.25 million, they will get their money back. They will get if it isn't if it is valued even less than that, well, then they will have to make do. They will have to satisfice with whatever lesser amount, right? But then they take loss, right? For that difference, they take loss. You understand? So basically, to the shareholders, right? So basically, bondholders, lenders, debt holders, they can limit their risk exposure because if it is a mortgage loan by the bank, then at least they have collateral. If it is bond, the lender, they won't buy this bond if this company's credit rating is poor. They will only hold their bond. They will only buy this bond if their credit rating is high. Okay, that way they can also limit their risk exposure. Anyway, so they are not really, investors in a very precise term, right? Because they don't take as much risk as their risk is limited. Only the equity holders are the true investors because they take the risk. They take the full risk. So to them, return on investment is return on equity. And the return on equity is basically, look, this is the capital gains. Profit is basically what? Capital gains and whatever dividend, right? Dividend or whatever. Capital gains and investment income. And dividend here is not their own dividend. Think about it. Dividend is not their own dividend because think about it, this company will buy stocks of other companies. They will invest in stocks of other companies so that the dividend paid is from the stocks they hold. It's not their own stock, right? Bond, it's not their own bond. They will hold, bonds of other companies. So interest payment will be from other companies. Dividends will be from other companies, right? And think about it. That happens a lot because you think Apple doesn't. You think Apple doesn't hold Microsoft stock? Apple holds Microsoft stock. Microsoft also holds Apple stock. They cross own each other in their portfolio. Think about it. It doesn't matter. Apple's portfolio will include a lot of good companies, regardless of whether it is Apple's competitor. Samsung, they will also have Samsung. Samsung also in their portfolio will also hold Apple, right? And Apple's portfolio will also include Berkshire Hathaway, etc., etc. And so return on equity is profit because that's what they that's the fruit of their operation, and then initial investment is their equity. And this initial investment is equity at time zero, right? Think about it. I told you previously that we need one income statement and two balance sheets. Do you remember that? And I said two balance sheets mean balance sheet at time zero and balance sheet at time one. Because all these assets and liabilities positions have changed over 1 year, right? Equity may have increased or decreased. Plant and equipment, current assets will depreciate, right? Plant and equipment will depreciate, right? Land doesn't depreciate, but building will depreciate. So all these numbers will change over 1 year, right? Now, income statement is by default, income statement at time 1. Why? You don't have any income statement at time 0 because you don't have any income. You understand? At time 0, you're just starting out. You don't have any income. You don't have any profit, right? You don't have any taxes. You don't have any, at time 0, you don't have anything. So income state, that's why I said income statement reflects the change that happened in 1 year period, right? And then over 1 year period. And then balance sheet, we need balance sheet at time 0 and balance sheet at time 1 so that we would know how much it has changed. And then, so if we dig further, this profit is actually earnings after taxes at time 1. Of course, that's at time 1, right? This thing is at the result at time 1. And equity is the original equity position because that's what was originally invested. So the return is the return to the original equity, right, at time 0. So return on equity at time 1 is profit at time 1, net profit at time 1, or EAT at time 1, over equity at time 0. If it is return on equity at time 2, this will be EAT at time 2 and equity at time 1. Does that make sense? Hmm? Everyone?
Yeah.
Does that make sense?
Yes.
Okay. And then, think about it. Equity at time 1 is exactly the equity at time 0 plus EAT at time 1. Why? This EAT net profit in ignore that negative number, just pause it. This EAT, who does that belong to? Who does the net profit belong to?
The owners.
The owners. Who are the owners? Who are the owners? The shareholders, the stockholders, right? Think about it.
Yeah.
So in terms of the nature of capital, in nature of capital, right? In nature of capital, what is the nature of this EAT? Huh? Do you understand? And I called nature of capital means what capital component is that? What capital component? Remember, I told you there are only two capital components, right? Either equity or debt. You understand? Do you understand? There's only two sources.
Equity or debt.
Yes.
What did you say?
You said so the two types of capital are equity or debt.
Can you slow down? You're just like, strafing a machine gun.
Sorry. The two types of capital are equity and debt.
Equity and debt.
Okay, perfect.
Right? There are only two types of capital, either equity or debt. I mean, look, that's what this balance sheet is telling you, right? I told you this side is showing the source of capital, and there are only two sources, either debt or equity. So there are only two types of capital, either equity or debt. So then, in terms of nature of capital, or in terms of nature of capital component, what is profit? What is net profit? What is EAT? Is it, that means the question is basically nothing but, is it debt or is it equity?
Equity, because you're getting it back.
It's equity because it belongs to the owners. Because it belongs to the owners, it is indisputably, undeniably, it's equity. And there are two types of equity, right? Or two types of, capital in general. Two types of equity, either paid in equity or retained earnings. Do you understand?
Yeah.
In other words, original equity at time 0, that's paid in capital, isn't it right? Equity at time 0 is paid in capital because the investors
So
bought stock,
then,
right? But then EAT at time one is the equity generated by the operating activity during year one. Does that make sense? It's
yes,
internally generated. And I said, so in equity, it's either paid in equity or retained earnings. Yeah, it's retained earnings. Think about it. If you didn't pay out any dividend, the entire profit, entire EAT is retained earning. Does that make sense? And if you paid out dividend already, then the retained earnings is the only capital left that was generated by the operating activity. Make sense? So then what is equity at time one? Equity at time one is exactly equity at time zero plus EAT at time one. Okay? Then what is the book value per share at time zero? At time zero, think about it. The equities at time zero is the you only have equity at time zero, and suppose that you the venture capital requested 1 million shares, right? 100,000 shares, and not 1 million shares, 100,000 shares. So we did it yesterday. Then what is the price per share? $40. Remember that? Because it's 4 million and divided by 100,000. That's book value at time, book value per share at time zero. Then at time one, what is the book value per share at time one? That's equity one at equity one divided by number of shares. And number of shares is still the same thing, 100,000, because they didn't sell any new shares. Then that is simply equity. What is equity at time one? That's equity at time zero plus EAT at time one. That is EQ1, right? So that's the book value per share at time one. But then that is the book value per share at time zero plus earnings per share at time one. Why? Think about it. What is earnings per share at time one? Is EAT at time one divided by number of shares. EAT. So think about it. You can break this up. If you can break this up into equity at time zero divided by number of shares plus EAT at time one divided by number of shares. So equity at time zero divided by number of shares is exactly this, right? Book value per share at time zero, and then EAT over number of shares is earnings per share at time one. That's basically common sense. Book value per share at time one is exactly increased. It reflects the increase in earnings, right? Which is earnings per share at time one. Okay, everyone has followed that. Everyone is okay with that. All right, thank you for the confirmation. All right, that's it for today. We're already 22 minutes past the hour, so that's it for today. I will see you guys on Monday. Please don't forget. Okay, I'm stopping. Okay, stop recording.